Welcome to Retire Mentorship. I am your host, Freeman Lindy, certified financial planner. Normally, I pre-record podcasts, and I try to do a bunch of them all at once to get me out several weeks into the future. I did not do enough episodes to get me through tax season, and while I was able to tack a few in here and there to extend the time that I had pre-recorded, I am fresh out of new content. But the show must go on. So for the next 3 weeks, so that I can get through tax season and help all of our existing clients get everything done that they need to get done, I will just be broadcasting the first 3 chapters of my book, 3D Retirement Income. I haven't played those on the podcast before, so it'll be fresh to the podcast. And so if you've never read the book, you'll get to experience those for the first time. If you have already read the book, you can get a refresher or skip the next 3 weeks. I won't be offended. And remember that you can get the full book by becoming a Retire member, which is you just sign up and you don't have to pay anything. We will just send you the book. And so if you haven't already read it and you listen for the next 3 weeks and you want to hear the rest of it, just sign up. 3D Retirement Income or 3D, retiremembership.com. There we go. And we'll get you signed up. So in the meantime, for the next 3 weeks, enjoy these 3 chapters of my book.
Chapter 1. Direction. Income that rises faster than the cost of living. Direction determines destination. Jim Rohn. Everyone agrees that you should grow money during your working years. Everyone agrees that most people should invest in equity funds in their retirement accounts. The prevailing thought is to invest in equity funds to grow your retirement principal for the day you retire. Retirement is the goal. Then you reach the goal. You've grown your money, and if you did it right, your nest egg is worth many times more than the sum of your contributions. Mission accomplished. Now the goal is complete. We switch the goal from growth and accumulation to preservation and decumulation. Switch your investments from equities to fixed income to keep your money safe. This would be a great strategy if the cost of everything you need and want to buy remained constant, but it doesn't. In the average 2-person 30-year retirement, your costs will double and may even triple. Prices go up permanently. You need an income that will outpace inflation. The first dimension of a 3D retirement income is direction. You need your income to go in the right direction in retirement. Up. You need your retirement to rise faster than the cost of living. The main thing that changes between your working years and retirement is switching from saving into retirement to pulling out of your retirement. You will be taking income from your portfolio, continuously pulling money out of your retirement accounts, either by selling investments and withdrawing the proceeds, or by taking the interest and dividend payments instead of reinvesting them. Your retirement income will be a constant drag on your nest egg. Investment strategies that may have produced a gain in your investment accounts while you were contributing to it may not result in a growth in income when you are withdrawing from it. We need our income to grow, not just our accounts. The need for growth. Perhaps the introduction did not properly convince you of the risk of inflation. If you're the type of reader who skips acknowledgments, forewords, and introductions, stop now and read the introduction. It's crucial to the book. Let's look at inflation again. The average 2-person retirement is 30 years. I frequently get new clients who, tongue-in-cheek, quip that they'll be lucky if I make it to age 75. While a short retirement is easier to fund, let's not build our whole retirement plan on the requirement that you die young. You may not. If neither of you smokes, the odds are very high that at least one of you will live for 30 years in retirement or more. We don't know exactly how long you will live. We don't want to build a plan that has you sliding into home plate with $0 in the bank. An old joke says that you only want to have to write 2 checks when you die, one to the undertaker and one to the tax man, and you want both to bounce. It may be humorous, but it's a bad plan. Let's suppose that you live 30 years or longer. If you die sooner, you'll be a blessing to others. If you assume you'll die early but live longer, you become a burden to others. Plan to be a blessing, not a burden. Look back 30 years. We'll use 1992, 30 years prior to publishing. What did items and services cost back then compared to now? In 1992, a first-class stamp cost 24 cents. It costs 58 cents today. A gallon of gas cost $1.13. It's currently over $3. A movie ticket costs $4.15. It costs anywhere from $9 to $17 now. The average domestic new car sold for $17,000 in 1992. Today, it is $42,000. The median home price was $121,000 in 1992. The price in 2021 was $269,000. You get the idea. Except for the first-class stamp, a good proxy for inflation as any, there is variation in the prices for all these goods today. But the trend is the same. The Consumer Price Index, which tracks the costs of the essential items we all buy, has increased by an average of 2.3% over the last 30 years. It's higher if you go longer. From the time you retire to the time you pass, prices will double or triple. Now think back to what you earned 30 years ago, or 30 years before you retired. What was your annual income in 1992? If you can't remember, your Social Security income history will show you. Most people give a smirk or even a snicker when they think about what they earned compared to now. Would you be satisfied if you still earned what you made 30 years ago? Of course not. You'd be destitute. You couldn't possibly live on that income. Retirement is no different. You will need your income to increase over the next 30 years in the same way it has needed to increase over the last. Unless you plan to cut your lifestyle and expenses in half over your retirement lifetime, you will need your income to increase. It's not negotiable. You need the first dimension, direction, income that rises faster than the cost of living. Only then will you be able to maintain your standard of living and impact. Let's clearly establish what doesn't work, and then we'll determine the best way to establish direction in our retirement income. Throughout the first 3 chapters, we will look at 2 popular retirement income strategies. 1, fixed income, and 2, annuities. We will look at how these strategies fail to create 3D retirement income and ultimately fail to give you a successful retirement. We'll explain what they are and the problems of each. Let's first examine how a fixed income strategy fails to create retirement income that will rise faster than the cost of living. Rising income, falling balance. We will need our income to rise. It must. Not only will the price of everything you want to buy increase, everything you need to buy will increase. Therefore, your income must increase to match it. The only other option is steadily cutting out everything you want to afford everything you need. Surely some people will end up there, but let's assume we are trying to provide for our needs and our wants. What is happening to the balance of our nest egg while our income is increasing? Our withdrawals will increase to maintain that income. For many who don't follow the 3D model, it means their balance will be falling. Year by year, decade by decade, their retirement balance will decline. The problem with the falling balance is that you will eventually run out. Anytime the balance of your retirement nest egg starts to go down, you are triggering a sequence that eventually ends in running out of money. At that point, you are hoping that you run out of time before you run out of money. We'll cover this issue in the next chapter. How do we find ourselves in this situation? Our nest egg withdrawals, plus inflation, are greater than our nest egg growth. This happens when our nest egg is primarily composed of fixed income. What do we mean by fixed income? What is fixed income? Fixed income is the collective name for anything with an interest rate attached to it. Bonds, treasury bills, certificates of deposit, savings and money market accounts, fixed annuities, etc. If you were to buy a bond, a T-bill, or a CD directly, you would get a fixed interest rate. If you put $1,000 into a 4-year CD with a 2% rate, you would have $1,083 4 years later. If you put $1,000 into a 30-year bond with a 4% rate, you would get $40 per year for 30 years and then get your $1,000 back when the bond matures. If you put $100,000 into a fixed annuity that paid a 5% income, you would get $5,000 per year as long as you keep the annuity. Fixed income. You get a fixed amount of interest for a fixed amount of time. All these together are called fixed income. You can also buy funds that contain these fixed income products. You may want higher interest without having your money tied up for 30 years in a long-term bond. You can buy long-term bond funds that constantly buy, sell, and redeem long-term bonds. Bonds bought 29 years ago will be maturing next year, and bonds bought today will mature much later. Because these fixed income products are all bought and sold on the open market, funds will still fluctuate in value. Although the underlying products are fixed, the funds are not. There isn't a guaranteed return when you buy a fixed income fund, but the returns and the value of the fund tend to be more stable. What is the problem? Over the last 30 years, a fixed income portfolio of long and short-term bonds and government securities had an annualized return of 5%. Fixed income returns have been even less in the last 10 years as rates have decreased. Inflation over the last 30 years has averaged 2.3%. What does that mean? Let's look at an example. Meet Chuck and Diane. They are both 62 and are retiring. They have a portfolio of $1 million for easy math. They hope to withdraw $50,000 a year the first year and increase that income to keep up with inflation. They are invested entirely in fixed income. The first year they withdraw $50,000 on January 1st to set it aside in a secure money market account. From there, they make a monthly transfer to their checking account for income. Their retirement account then grows 5% throughout the year. On December 31st, the $950,000 has grown to $997,500. A quick note to the audio listeners, we do have the accompanying PDF for the audio where a lot of the figures and charts and graphs will be displayed. Some of this gets difficult to talk about over audio without being able to see it, and so I'll reference that PDF as we go. In the meantime, I'll try to add a little bit more commentary in the audio versus just reading the text so that you can better understand it if you're driving or are otherwise unable to view the charts in the accompanying PDF. But I encourage you to go back and look at those charts. This first table shows $1 million as a starting balance on January 1st. You then pull $50,000 out for income. That leaves $950,000 as a balance in the account to grow. That makes sense, right? $1 million minus $50,000 is $950,000. That balance then grows by 5%. And when you grow $950,000 by 5%, you end up with $997,500. And that would be the balance on December 31st of that year. What happened? If their withdrawals were 5% and their growth was 5%, shouldn't it be equal? Shouldn't they be back to $1 million? Not if the withdrawals come first. $950,000 doesn't compound as well as $1 million. If they had let their $1 million grow for a year and then taken their income on December 31st, it would have grown to $1,050,000. Subtract the $50,000 for income then, and you're back to $1 million. Here's the thing about being retired. You need the income all year. You can't wait until December 31st to take the withdrawal for that year. You need the money in January, February, March, etc. Even if you pull your money out monthly, you still need it at the beginning of the month, not the end. And for simplicity, we will go with the annual withdrawals of scenario 1. Chuck and Diane want to increase their income to match inflation in year 2, increasing 2.5%. On January 1st of year 2, they withdraw $51,150 and run it another year. So now we have the $997,500 from the end of last year, and that's going to be our starting balance on January 1st. Now instead of pulling out the $50,000, we pull $51 and change out. This lowers our balance to about $946,000. When that then grows by 5%, we are left with $993,000 and some odd change. Chuck and Diane have a little less money in their portfolio each year, and each year they withdraw a little bit more from their portfolio. In the accompanying PDF, you will see a portfolio value of fixed income with flat 5% returns. It starts at $1 million and then continues to decrease. It starts accelerating downwards, falling by more and more each year, and eventually runs out in year 27. It doesn't seem to make a big difference in the early years, but as the years and decades pass, the income compounds upward and the account compounds downward. Each year, less in the account means less to compound. The growth number is smaller and the withdrawal number is higher, and the account accelerates downward. Eventually, they run out. When the growth of a portfolio is less than the withdrawals plus inflation, this result is inevitable. You will run out. It's merely a matter of which runs out first, your money or your time. You are inviting the second outcome from our introduction. Door number 2, the people outlive the money. You can attempt a fixed income strategy if you feel risky. You can hope that it works out. For example, you can hope that you run out of time before your nest egg runs out of funds. Wishing for your speedy death seems a bit morbid. You can hope that your expenses only increase with inflation and that you will never have any significant, unexpected expenditures, which is not likely. You can hope that inflation never takes off and increases your expenses faster than your fixed income growth. It does happen. If you believe hoping for a fixed life is a prudent course of action, you can attempt this risky strategy. And that's the key. A retirement portfolio comprised primarily of fixed income investments is risky. You may limit volatility, but your ability to outpace inflation and adjust to changing life circumstances is extremely limited. More on that in Chapter 3. You are still susceptible to the primary retirement risk, inflation. And while it's evident that a fixed income portfolio cannot produce an income with the proper growth, millions of baby boomers are relying heavily or exclusively on fixed income to do something that it was never meant to do: create an income that rises faster than the cost of living. Let's look at another popular retirement strategy and see if it achieves the first dimension. Annuities, death on a fixed schedule. Okay, the subheading gives it away. Annuities don't work, or at least they don't work well. Let's unpack. What is an annuity? An annuity is a contract issued by an insurance company. You pay the insurance company an initial lump sum premium, and they guarantee an income for life in exchange. No matter how long you live, they will keep paying you that income. In a sense, then, you can never spend it down. There are dozens of variations of annuities, and a deep dive into those variants are beyond the scope of this book. Let's talk about the average annuity. If you pay the premium, the annuity will pay a percentage of that premium to you as monthly income for life. That percentage varies based on your age when you start the income. You might get the following percentages based on these ages. If you take the income before age 60, you may get 4.5%. If you take it between age 60 and 65, you will get 5%. Or if you take the income at age 65 or older, you could get 5.5%. If you pay $100,000 from your IRA into an annuity and start at age 65, you will get $458 each month until you die. That's $5,500 annually before taxes, or 5.5% of what you put into the annuity. These are based on single life payout, meaning that it pays you as long as you live. It doesn't factor in your spouse. If you pass away at age 105, you will have been paid $220,000 from the $100,000 you put in. That appears to be a good deal. But if you pass away at age 75, the payments stop. You will have received only $55,000 of the $100,000 you paid. And if your spouse is still alive, they get nothing. You can remedy this by making a joint and survivor annuity instead of a single life annuity. Then it will pay out the income as long as either of you is alive. Even if you die at 75, you still win if your spouse lives to 105. But there's a cost. Joint annuities pay less than single annuities. If the company has a greater chance of paying it longer, it'll pay less. The schedule now may look like this. If you take the income before age 60, you could get 4%. If you take it between age 60 and 65, you would get 4.5%. And if you take it at age 65 or older, then you'd get 5%. That's a 0.5% lower for each band than you'd get on a single life annuity. The same $100,000 is now only going to pay $5,000 per year instead of $5,500. And if you are married, you'll certainly do a joint option because of the risk of one of you dying early and leaving the other with nothing is too great. Still, 5% for life doesn't seem bad. If you live a long time, you both win. If you both die young, the insurance company wins. A fair trade. Sure, if you die young, your heirs will get less, but let's solve for our retirement first. Chuck and Diane have $1 million in their retirement, and they are meeting with a financial representative. Financial representative, or financial rep, is a person who represents a financial company and its products. They will sometimes call themselves financial advisor or financial professional. I will not be calling them advisors because true advisors sell advice, not products. There is a technical distinction between reps and advisors, which we'll get to in Chapter 12. For now, we'll call them representatives or professionals. The financial rep may present an annuity to Chuck and Diane as a good option. The rep recommends that they create some guaranteed income with a portion of their retirement and that they put $300,000 of it into an annuity. They'll get $15,000 per year paid out at $1,250 per month. If they add that to their Social Security income, they have a guaranteed retirement income to cover their necessities. Plus, it's only a portion of their nest egg, the rep reasons. They can invest the rest using other strategies. Perhaps they can invest the rest primarily in fixed income, so they don't lose it in the stock market. They reckon it is the beginning of a solid retirement income plan. The 4% safe withdrawal rate. An oft-cited rule of thumb is called the 4% safe withdrawal rate, or 4% rule, which states that you can safely withdraw 4% of your investments each year. If you try to withdraw any more, you seriously risk running out of money. We saw this earlier in the scenario when Chuck and Diane were withdrawing 5% per year. Many financial representatives love using the 4% safe withdrawal rate when selling annuities. Look, they say, you can either withdraw 4% of your retirement portfolio so you don't run out of money, or you can choose a guaranteed 5% withdrawal for as long as you both live. Your choice. Plus, you don't need to worry about the stock market. It's guaranteed. When the stock market tanks, or if you both live past 100, you're covered either way. When you put it like that, who can argue? Let's go with the annuity. Where do we sign? We forgot about one thing. Inflation. Your 5% payout is a flat income amid rising costs. Again, your 5% payout is a flat income amid rising costs. Annuity income doesn't change. It's a percentage of the original amount forever. That $1,250 per month isn't going to feel like much when the items it could buy at the start now cost $2,500. Somehow, financial representatives always neglect to point this out when selling annuities. By the way, the 4% rule is a guideline for withdrawing 4% of a growing portfolio. If your portfolio is growing, the 4% you take is also growing, hopefully keeping up with that inflation. It's a woeful misrepresentation to compare a 5% flat income stream against the 4% rules as if it compares apples to apples. It does not. Annual demotion. Picture this. You are 30 years old with 30 years ahead of you to work. You are looking at 2 jobs and you have 2 offers. Acme Corp is offering you $50,000 per year. Bravo Company is offering you $40,000 per year. The workload and benefits appear to be identical. What gives? Why is Bravo Company offering so much less for the same work? You investigate. You discover that Bravo Company is employee-owned and does lots of profit sharing and bonuses. The $40,000 is just the base salary, and while technically not guaranteed, they have always paid it. And while no company can guarantee they will make a profit each year, Bravo usually does. The profit sharing in the past has been anywhere from $10,000 to $30,000 per year. Moreover, many current employees save some of their $20,000 plus bonuses in good years for the rare years when there are no profits. Okay, not so bad. You investigate Acme Corp. They can guarantee $50,000 right out of the gate, but it comes with two downsides. Downside number one, each year they reduce your salary by 2.5% compounded. In 30 years, you'll be making about $23,000. This too is guaranteed. Number two, there's a penalty if you try to leave the company. Once you sign up, there's no going back. Even if you try to leave in the first year, you must pay them $70,000. The penalty goes down each year from there, but it is still high. After your investigation, you conclude that you want to work for Acme Corp. Sure, there are downsides, but the extra $10,000 in year one and the fact that the salary is guaranteed are worth it, right? Of course not. No one would take that deal. But that's precisely what we are doing when we put our money into an annuity. If your income is flat and the costs are rising, that's equivalent to a guaranteed reduction in real income. We don't think of it that way, but this is effectively what we are signing up for. Annuities fail the first dimension, direction. Their income remains flat while our mortal enemy is constantly working against us. What is more, they have enormous penalties for trying to get your money back. Annuities have a surrender period of around 7 years, where you will be penalized for pulling your money out. If you try and surrender your annuity, pull the money out, in the first year, the penalty is usually a 7% subtraction before giving it back. If Chuck and Diane get cold feet and surrender their $300,000 annuity, the penalty is $21,000. Annuities only pay you about 5% per year, so it costs more than an entire year's income to get your money back. And the fees inside the annuity can be 2 to 4% annually. So even after you get out of the surrender period, the annual fees have decreased the amount you can get back out substantially. 7 years at 3% is 21%. If Chuck and Diane leave the annuity in place for the 7-year surrender period, it will cost them $63,000 in fees. Suddenly, the surrender penalty isn't looking as bad. But having to choose between paying $21,000 or $63,000 to get your money back is not a place you want to be. Getting that annuity was an expensive mistake. Underwhelming annuity income. Beyond the flat income and the high fees, the upside of an annuity is very underwhelming. Typically, you must wait until age 65 to get a 5% income stream. But with a flat income, you aren't getting much. The life expectancy of a 65-year-old male is 18.2 years and is 28.8 years for a female. Let's say age 85. Guess what? You can put the same premium in a savings account, earning 0% interest, and still pull the same income from the account for 20 years. If Chuck and Diane put their $300,000 in the bank and pulled out the $1,250 per month, they'd still have 20 years of income. Moreover, it would only need to earn 1.85% interest on an account to make a flat income last 25 years to age 90. You must significantly outlive your life expectancy to get a positive return on an annuity. Why are annuities so popular? If annuities are a guaranteed demotion each year, death on a fixed schedule, why are they so popular? Simple. Large commissions. The typical upfront annuity commission is 7% of the premium. Think about the financial rep who recommended that Chuck and Diane put $300,000 into an annuity to guarantee $1,250 per month. That financial rep would receive a $21,000 commission check for that recommendation. $21,000. Does anyone smell a conflict of interest here? A recommendation to lock your money in a contract that you'll likely earn less than 2% on so they can make $21,000. And if $21,000 seems like a familiar number, it is. It's the surrender penalty in year one. That's why surrender penalties exist. The company already paid the financial rep a considerable commission. They may try to pull some of that commission back from the rep, but in the meantime, they're going to make sure you pay for it. The alternative for the rep may be to put you into an advisory account and charge an advisory fee for managing it. Perhaps the all-in fee for the client is about 1.75% per year, 1% of which goes to the rep. Advisory fees are paid quarterly, so they get paid 0.25% each quarter. Think about how the rep is paid for both options. Recommended advisory account, earn $750 this quarter and each thereafter if they can keep the client. That's 0.25% of $300,000. Or recommend an annuity and earn $21,000 now, and it doesn't matter if they lose the client or not. $750 versus $21,000. Tell me there isn't a perverse incentive there. Tell me the rep wasn't swayed even one iota toward favoring the annuity based on the payday. Some financial reps will argue that they don't do it for the commission. The annuity is a good product and the client needs some guarantees. The annuity is a good fit. The commission is ancillary. Then why is the upfront commission so attractive? Insurance companies offer 4 or 5 payout options with a combination of upfront commissions and recurring payments called trailing commissions or trails. When you sell an annuity, your choices of compensation may look like this. Option A, 7% upfront, 0% trails. B, 5.5% upfront with 0.25% trails. C, 4% upfront with 0.5% trail. D, 2.5% upfront, 0.75% trails, or E, 1% upfront and 1% trails. We'll have this table in the PDF as well, so go back and review the PDF as you're reviewing the chapters, and then this will be easier to see. Overwhelmingly, reps choose option A or B. Even though you get paid more over the contract's lifetime with trailing options, the pull of those colossal paychecks is too strong. Moreover, many annuities offer an advisory option. The standard commissionable annuity has the commission schedule and the surrender penalty, but the advisory version has a standard advisory fee with no surrender penalty. The rep could get paid the same quarterly fee on the annuity he's recommending as on the advisory account, $750 per quarter. Some advisors do this. They are true fiduciary advisors who act in your best interest and don't sell commissionable investments. They get paid the same regardless of the account type recommendation. But the overwhelming majority of annuity sales are for the commissionable kind, and in my experience, most reps take the upfront commission. The payouts on these products are massive and hard to resist. They help explain why annuities are so popular. A bad deal. Annuities are a terrible deal. The rep who's recommending it will make 7% on the amount they are recommending. You will need to pay a hefty penalty to get your money out and a sizable annual fee if you keep it in. And most importantly, you get a fixed income for a life of rising costs. I don't know about you, but I would not want to be walking into 30 years of rising costs on a fixed income. Other objections that financial reps may raise are, well, I only earn a 3% commission on my annuity. Good for you. You get paid half as much to put someone in a fixed income amid rising costs. They are still no better off than putting their money in a bank from a life expectancy standpoint. At least the bank lets you take your money back out without penalty. Well, my annuity pays 6% when you activate it at age 65 or older, not 5%. You're misleading them. Good for it. It's slightly less terrible than the standard annuity. If you want to take out 6% of your original balance as a fixed income at age 65, you only need to make 1.86% to make it to your life expectancy, and only 3.5% to make it to age 90. Guaranteeing a fixed income of 6% is not impressive, and it's still a fixed income amid rising costs. Well, my annuity has a death benefit that will pay back the original amount invested on top of the guaranteed income stream, or substitute whatever shiny bells or options or whistles the annuity has. If you do the math, which those who are not earning the 7% commission have done, the return is still not great. It is an expensive product with a surrender penalty, poor returns, and creates a fixed income amid rising costs. I hope I've been clear. Annuities are among the most popular retirement strategies, at least with those who sell them. Trillions of dollars get poured into these profitable products each year. And make no mistake, they are very profitable for the companies that make them. And yet they miserably fail the first dimension of a good retirement income plan. They don't rise faster than the cost of living. They don't rise at all. Both fixed income portfolios and annuities fail the first dimension. They are recommended to retirees to protect them from the volatility of the stock market. In reality, they doom clients to be ravaged by their mortal enemy, inflation. Retirees may be struck by a falling balance built by a fixed income portfolio that can't support rising withdrawals. Or they may realize their annuity is merely death on a fixed schedule as costs march onward and upward. Either way, adherents to these safe retirement income strategies will find the strategies couldn't have been that safe if they still run out of money. Let's choose to build our retirement income in line with direction. Let's build a retirement income that rises. Moreover, let's build one that rises faster than inflation. We will explore how to create this retirement income, but first we must look at the other two dimensions. 3D retirement income is interconnected, and we can't solve the first dimension without simultaneously solving the other two. Take a breath to review before moving on. Chapter 1 Summary. We need to build a retirement income that goes in the right direction, up. We need our income to rise faster than the cost of living. The cost of everything you need and want to buy will double or triple during your retirement. You must have a rising income, or you'll need to cut your lifestyle in half. A fixed income portfolio of bonds and government securities will not earn enough to support income plus inflation. Once your portfolio begins to decline, it is only a matter of time before you run out of money. A fixed income heavy portfolio is a risky retirement strategy. Annuities are contracts that pay a flat guaranteed income for life. Annuities pay a hefty commission to the rep, are very expensive to keep, and inflict a significant surrender penalty to cancel early. The return on an annuity is 0% for someone's normal life expectancy and less than 3% even for those who outlive their projection. Annuities lock you into a fixed income amid rising costs. The guaranteed income won't feel that helpful when it remains the same and the cost of everything have doubled. You need an income that rises faster than the cost of living. Neither fixed income nor annuities can provide that.
If you enjoyed that, you would love being part of our free membership community. It's called Retire Membership, and it has a host of benefits all for free. For example, you can always buy my book, 3D Retirement Income, on Amazon. But if you join us at Retire Membership, we will send you either a hard copy or paperback for free, provide the ebook and the audiobook so that you can listen to it if you don't have time to read it. In addition to that, we'll also provide you with a bunch of content that you can't get anywhere else. For example, we have our quarterly Retire Mentorship magazine, which comes out quarterly and has no ads whatsoever. It's just timely content to help you stay the course. We also have workbooks for our free online workshop to help you get the most out of those, flowcharts to help you make better decisions, and a weekly email to provide timely content that you can unsubscribe from at any time. We never ask for any payment information, and we never share your information with anyone else. We just want to provide timely content and help you stay the course to retire successfully and stay successfully retired. There's no reason to wait, so join us now at retiremembership.com, where you can click in the link in the description and it'll go right there. We can't wait to see you in the community. Cheers. This podcast is educational only and is not investment, tax, or legal advice.